Welcome to Market View with Ike Iosa and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now. Market Views with...
Good morning. Mike Iosa, your host for Market View guest, my good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How are you?
I'm doing well. And Mark, we did an interview on March 26th, 2 days after the bottom, and at that time you made a very good case that the worst was behind us and the market was going higher. 8 weeks later, I'm curious to hear your thoughts because we have gone straight up. And in fact, I was speaking with another friend earlier and I was commenting that V-shaped bottoms in the stock market are rare, especially of great magnitude, and we have had two V-shaped bottoms within 2 years, the one bigger than the other. That's even more rare.
I guess we're going to have to start rewriting the technical analysis books because you're absolutely right. At the time there, towards the low, I thought we made a low, is the way I like to put it. I thought we could rally from there, but I thought because of the huge amount of technical damage to so many stocks, almost every stock you could say was damaged quite a bit from a technical basis. I thought we'd have a nice run up. Steepness of the decline has helped here as there's no real chart resistance on the way back up, but I thought we would have some backing and filling and possibly, go back and retest. And after a while, I kind of threw the towel in on that. I did think we would get a pause. We've had a pause kind of late April, early May, but, the V bottom in most of these indices is still there. That's the structure we're seeing. The first chart I have is an hourly of the S&P. Towards the end of May, after going sideways for a bit there, we broke out, retested, and then we've grinded higher ever since. We hit the top of the channel here, overbought, extreme overbought on an hourly basis, pull back, rest, it's like rinse and repeat, it just continues on and on. If we move to the daily chart, we're also getting close to the top of the channel. These channels can always be redrawn down the road. So we are getting close here to 32 plus 3250 area. Could provide some channel resistance. We do have a gap up here. Starts around 3260 and runs up to 3328. So that's also a possibility. We fill that before we pull back. But, eventually, I think the market, many people disagree, technicians anyway, would disagree that, we're going to go back to the old highs, and we will eventually see some kind of pretty large pullback to shake things up a bit. Some sentiment indicators have gotten a bit stretched, but not all of them. And a lot of them are still neutral to bearish. If we move to the next chart, the market breadth, number of stocks going up, the number of stocks that have repaired themselves, advanced decline line, the advanced decline line of volume. Any way you slice it and dice it, we've seen a fairly, a massive improvement in market breadth. This chart shows the percentage of stocks on the S&P 500 that are above the 50-day and 200-day. Both were down near zero at the bottom in March. The percent of stocks above the 50-day, I think, hit 98% the other day, which is the highest I've seen, I think, over the past couple decades. And the percent above their 200 is up to 50. We always like to see this eventually get up over 60 or 65%, but it's out of the danger zone finally as it's creeped back over the 45%. So just great improvement in breadth, great improvement in many chart structures, which I think sets us up pretty good for the rest of the year.
How about the next chart, which is TLT? It looks to me that the bond market is rolling over.
Yeah, I would agree here. Besides stocks, maybe that's one of the stories of the week with an asterisk. We've finally seen some action in the Treasury bond market. Yields have jumped up out of this symmetrical triangle. There's also, you'd probably draw an ascending triangle in here. When we look at yields versus price, the way I write it, support resistance get reversed. So on a price chart, support is down below, resistance is overhead. When I look at a yield chart, I reverse that. So the first area of support for yields is that previous high around on March 18th up near 1.7. That was the last peak. And then you have the declining 200-day moving average, which is around 1.38. So I think there's a good shot that we move to either one of those levels. And that's a good sign. We've been waiting for this. I think we can put to bed, or will put to bed, this sub 1% on the 10-year and sub 2% on the 30-year. It's a good sign for stocks. Investors are finally anticipating some improvement down the road in the economy. So this is a good setup for stocks here.
How about gold? Gold had bigger V-shaped type of bottom, but then we've gone sideways for 6 weeks. Now it also looks it's breaking down.
Yeah, this is a tough one. Where do you draw the trend lines? Do you take the mess out from March and try to draw a channel? I would say, I prefer horizontal support, and you look at the lows recently, they're in the 157, 158 area, which is where we are about right now. I'd say if we break 157, we could see a pretty good correction here. The one negative, as I just talked about, is Treasury yields going higher. I think that's probably the reason that gold has sold off here this week.
Also, if you look at the MACD, it has been diverging negatively for roughly about 5-6 weeks. It's pretty close, going below the zero line.
Yep, that would be a negative. You're right, there were multiple negative divergences, non-confirmations on both the MACD and the RSI. MACD below zero, 14-day RSI below 50 are warnings that, something more to the downside could be coming.
How about oil? Oil has had an unbelievably crazy move also the last 8 weeks. But it looks like we're getting an inverse head and shoulders. It looks to me that it could go up to $46-50.
Yep, I would agree. Many times with these inverse head and shoulders at a bottom, you get a very small, hard to even call a right shoulder, an abbreviated right shoulder versus the left shoulder. That's very typical of an inverse head and shoulders bottom. We're up at 39, 50, 55 here right now. Just like stocks, there's a gap here that runs up 41. 43 is a 61.8% retracement of the decline, and the 46 level is the declining 200-day. And as far as any kind of chart resistance, we really don't have any until we get into the 50 or low 50s area. So, we'll probably see, we've seen some nice moves in some oil stocks too this week, which is, a good sign.
I look at the spiders like XLE, XOP, and they have had pretty nice moves as well. The next chart, the ETF for Latin America. One thing interesting about this chart is that it does look that it has formed a quadruple bottom.
Yeah, this is pretty typical of a lot of the stocks that got wiped out, whether we're talking about emerging markets, ETF stocks, whether we're talking about oil stocks, cruise line stocks. The stocks that got hurt the most bottomed in March, tried to rally a couple times and then went sideways. And I'd say over the past, just this past week or so, we've had big breakouts in oil stocks. We've had big breakouts in most of the emerging market areas. And if you'll note, if you look at the steepness of the decline in late February into the March bottom. And it's basically straight down. And this is the kind of chart, once it gets going, there's no sellers. There was no buyers on this chart, all the way up to the 30 area. If you go back to late last year, early this year, the 200 days way up at, near 28. So there's very little chart resistance, very little overhead supply, and this is where the action has been, I'd say, over the past week or so. And when these things finally break out of their ranges, boy, they're just rocket ships to the upside.
And here, would you like to add any thoughts, observations?
Yeah, what's interesting, I forgot to mention about the Treasury yields. You have two other dynamics here that are in favor of higher yields. As the world looks at today's economic statistics or backwards, I don't know what the heck people are looking at and expecting here. Not expecting a whole lot, but sentiment towards the bond market is pretty bullish. Now, it might take a little time here, when bonds breaking out for sentiment to calm down, but everybody thought, we're heading for a depression and yields are going to go down to zero, negative yields, whatever. So that's a real negative here for bonds. The other one is that the COT data is also negative for the bond market. Commercials have reduced their exposure, they're the smart money, while large speculators have raised their net futures positions in the 10-year. So you have a negative chart, you have too bullish of sentiment, and you have negative COT data. So there's a whole host of things that are going against the bond market. So it'll be interesting to see what happens here in the next couple months.
Mark, thank you. Have a great weekend.
Thank you. You too.
And you too in there too.